Welcome to TheoTrade. This is Don Kaufman. It's July 22nd, 2019, and you are watching the TheoTrade evening video. Just a few minutes left to play in the trading day with the S&Ps up about 10. Now, the Nasdaq, though, is a lot stronger to the tune of about 1%. And the Russell, well, the Russell continues to be the divergent product here. The Russell's actually going to close on this trading session down. Now, whatever you might see inside of, today's trading tape, brush it aside a little bit. Why? Well, we got the financials flat, and all really of the gains of today's marketplace, they're coming from none other than the monsters of tech. Remember, the monsters of tech, that's our Facebook plus Apple plus Microsoft plus Google plus Amazon, right? And almost all of those have earnings this week. So when I say kind of take today's trading session with a grain of salt, that's because this is it. If you're into earnings, this is the main event. This is the biggest week for earnings during this quarter. And hey, listen, there's not that much else on the calendar. I mean, the Fed speak has stopped, of course, until this Thursday, because Thursday you have the European Central Bank. But other than that, it's an earnings just extravaganza throughout the course of the week. In fact, I want to figure out what earnings trades that you might consider. First of all, I'm going to close up this left side bar. I'm going to cruise over to the scanner here inside of thinkorswim. And I'm just going to let you know kind of, well, my fields. First of all, I'm scanning in nothing more than weeklies. For those of you that have no idea what the weeklies are, those are underlyings that have weekly options. Now, just because they have weekly options doesn't necessarily construe that there's a ton of liquidity. Nevertheless, it's a good place to start. Like for me, if I'm going to trade earnings and earnings announcements, come on, if it doesn't have weeklies, I'm not even going to consider trading that particular product. So I scan in weeklies. The next thing, earnings. Has earnings anytime, I'll pop up the next 4 bars. By the way, bars are defined as days in here. But the reality is I pull up four days worth, and you got 90 different products to select from. So with that, you can kind of thumb through a little bit. You've got Boeing. Of course, that's going to be a large one because Boeing is the single largest constituent inside of the Dow. You've got none other than Amazon. We go down the list, some of the usual suspects. Google. Okay. I mean, again, where do you want me to start? Where do you want me to stop? Intel's coming out. These are heavy market caps over here. Looking down towards the bottom of the screen, some other interesting ones, maybe Snapchat, which has had a wild rally thus far in the last couple of months. Nevertheless, one of the things that I want to talk about, on today's evening video are a couple of trade ideas, a few trade opportunities, and there's the closing bell. A couple of trade opportunities around earnings. One of the things that has changed, I believe, substantially in more recent years in this marketplace would be the efficiency, if you would, of the marketplace. And when I talk about efficiency of the marketplace, let's go ahead and cruise over to a product like Microsoft. Now, Microsoft, yes, it had its earnings last week. In fact, we can go to the Analyze tab. We can actually back up, okay, to, for example, the day before, the day before the Microsoft earnings. And the reason that we'll do that from time to time, is we can then evaluate what we term expected move. Now, what's expected move? This is, the option market, it's its interpretation, it's its expectation, if you would, of how far this stock is going to move when the earnings come out. And one of the questions that you always get, of course, is, all right, Microsoft's supposed to move $4.78. Well, first of all, that's not exactly what it says. It's supposed to stay in the $4.78 range. Now, can it crack outside that range? Of course it can. But what you have to understand is that this right here, that is not, and again, I'm going to highlight that for a second. That's not just some random number, That number is based on the options inside of this chain. And I can't stress this enough. Again, this expected move over here, it gets all misconstrued. It's some, geek calculus, some equation. No, really what it is, it's like an average of like at the money options in a given chain. So if you added up these puts and you added up these calls, like literally add them together, you're going to derive very close to what we term kind of expected move. And there are literally billions, okay, and billions of dollars worth traded in options in a product like Microsoft. Look, there's 12,000 contracts that traded the day before the earnings. And that, by the way, that's just in this 2-day option. Okay, so what you see in terms of the expected move isn't just pulled out of thin air. It's not just some random number. Okay, it's a real skin in the game, okay, interpretation of how far this stock is anticipated to move. And as I said, one of the things that's changed just changed drastically in recent years is the efficiency behind this. And when I say the efficiency, okay, when it says, well, we're supposed to move $4.78, the stocks have actually been drawn to the edges of those expected moves, which then that really positions a huge problem. And the problem is this, when you're trading earnings, okay, what can you really do around earnings? Well, you can go into earnings and you can buy options. You could turn around, you could sell options. So what side of earnings do you want to be? When I say you want to buy them, I mean, people can go out there and just buy like an at-the-money straddle. Now, this conversation is getting a little deep over here, so kind of put your helmet on. You can buy an at-the-money straddle. If you buy an at-the-money straddle, that means you need us to move more than 478. But if you sell an at-the-money straddle, that means you need us to move less than 478. Well, if you have enough traders, okay, on either side of that, one on the buy side, one on the sell side, what do you get? We actually get drawn right to the edge of the line. What's the edge of the line? That's the 478. And it's one of the reasons, again, that you see time and time again, we keep moving to the edge of what is expected. Now, of course, I say this without an equivocation, somebody is going to be able to point out, you're like, wait, but a stock like Netflix, well, Netflix in the week, and specifically last week, Netflix actually moved, okay, double what was expected. Listen, Netflix was supposed to move $25. But it's the actual move the next day was 37. You're like, oh, it's outside. But then, okay, coming into the weekend, it actually moved closer to 50. So it actually moved net about double the expected move. So is it always true? Of course not. You have to understand, okay, that what I'm discussing and looking at this idea that we're, supposed to move up or down, for example, $4.80 or $4.70, okay, recognize that that's based on hundreds and hundreds of occurrences. So where should you be if you are going to be trading earnings, right? Should I go out and should I run out and should I be a buyer of options or should I be, a seller of options? Being a seller of options scares me. It scares me because what's going to happen is you're going to make a buck, 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 you're going to make a buck. And by the way, you're getting bigger and bigger in contract size, and then all of this gets wiped out and then some. I mean, listen, that's what happens to people that sell premium, especially when you sell premium and lower volatility. On the buy side, you buy and nothing happens, you buy and nothing happens, you buy and nothing happens. On the third time, you've already given up and you're like, that's it, I'm done. Well, I have a little bit of an answer to some of those problems, and that's this. I'm not going to go out necessarily and buy or sell. I'm going to go out and I'm actually going to trade the edge of the expected move. Now, what does that mean when I say the edge of the expected move? So I go through some earnings candidates, right? And I start to kind of sift through like what really interests me. Today I actually saw Intel. Okay, Intel was flying higher today. It had a couple of upgrades, if you will. So Intel was kind of flying higher, but its earnings are coming out later in the week, and I may elect to trade this earnings. What am I going to do around its earnings? Well, first of all, I'm not going to do this until very close to or right before the earnings announcement, okay? But I'm actually going to trade on the edge of expected. I'm going to trade on the edge of expected. It's something I'm going to detail in the chat room, okay? On Tuesday, Wednesday, okay, and Thursday this week at TheoTrade. And when I talk about kind of detailing it, what I'm going to do is I'm actually going to plot out, okay, here's this underlying, okay, the underlying happens to currently be worth $51. We're just going to round it. Let's call this a $3 expected move. That's intended to move $3 higher or, okay, intended to move $3 lower. I'm actually going to lay a butterfly, okay, on the upper or, not both, or the lower strikes. And again, I'm going to detail this throughout the course of the week of where I'm actually going to be laying a number of these butterflies. Now, you notice I'm using Intel. Yeah, okay. But Don, can I do this in something like Amazon? Okay, of course you can. But hitting Amazon, it's like hitting the broadside of like a barn, okay? It's a huge stock. And the butterfly is going to cost you a lot more, okay, when trying to hit the broadside of a barn. So if you take a look at something like Intel, it's going to be easier to zero in specifically on the strikes that you need to cover. Whereas Amazon, again, you're like, oh, that's going to be easier. You know, it's a $2,000 product. It's not. It's actually going to cost quite a bit more because you're going to have to buy some wide butterflies. In something like Intel, we should be able to zero in pretty carefully. All right, if the stock's trading at 51, just go like, $3, $4 higher or lower. Again, we're going to be able to zero in specifically on the butterflies in some, again, I think there's a number of products like Intel or Starbucks or even Caterpillar that are just more in your reach than, kind of going for the stars on a Google or an Amazon. Again, so what we intend to do is to lay the butterfly, okay, lay these butterflies right, again, on the edge of what is expected. So if we see, for example, a $2 or $3 expected move, we're going to be on the edge, higher or lower. We'll talk about, again, the directional bias in there. Now, one thing I'm going to kind of allude to, the directional bias of a trade like this, like how do I know? Should I get bullish or should I get bearish? It's not necessarily going to matter because if you go out and, for example, you were to risk, let's say 40 cents on a butterfly, okay, and that butterfly can yield anywhere between 200 to 300%. Okay, the directional bias does not mean much because you only have to be right. What? One in a few times. You think about it, even if you hit 1 in 3, 1 in 4, even 1 in 5 times, the reality is the bias, both bullish or bearish, don't necessarily make a huge difference, again, when the percentage returns are that high. It's all about where to put that butterfly, and that's exactly what we're going to talk about in the chat room live starting tomorrow. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.